In this video, we will walk through the core taxation rules for employee benefits in Denmark, focusing on how they are treated from both the employer's and the employee's perspective, and what you should be aware of when designing or receiving a Danish compensation package. Denmark is known for relatively high personal income tax rates, and the tax authorities take a comprehensive view of what constitutes taxable income. This means that most employee benefits, or fringe benefits, are in principle taxable and must be reported unless they fall under specific exemptions or thresholds. For employees, the starting point is that any benefit received as part of your employment, whether in cash or in kind, is generally considered taxable income, and the value is typically added to your salary for income tax purposes. For employers, the responsibility usually includes correctly valuing and reporting these benefits to the Danish tax agency, Skat, via the regular payroll reporting system, and ensuring that appropriate withholding is applied. The key questions are what is taxable, how it is valued, and which exceptions or special rules might apply. Let's begin with some of the most common benefits. Company cars are among the most significant taxable benefits in Denmark. If an employee has a company car available for private use, including commuting, a taxable value is calculated based on the car's original purchase price and age, using prescribed percentages set by Danish law. This imputed value is then included in the employee's taxable income, irrespective of how much the car is actually used privately. The employer reports this monthly through payroll. Fuel paid by the employer is typically included in the car benefit calculation or taxed separately, depending on the arrangement. Another frequently used benefit is employer-provided phones, internet, and computers. If an employee has a phone or internet connection paid by the employer and it can be used privately, a fixed annual amount is usually added to the employee's taxable income, rather than the full cost being taxed. This standard amount is intended to simplify administration, but it still means employees should understand that free telecommunications from the employer generally have a tax impact. In contrast, equipment that is clearly necessary for the job and used primarily for work purposes, such as a work laptop kept at the office, will typically not trigger taxation as a personal benefit. Moving to meals, gifts, and smaller perks, Denmark applies both materiality and purpose tests. Free or subsidized meals at the workplace, such as in a canteen, may be taxable if the subsidy is significant, but in practice there are guidelines and thresholds that can make modest employer-subsidized meals either tax-free or taxed at a standardized value. Occasional business-related meals are generally not treated as a benefit to the employee if they are clearly linked to work activities. Gifts from the employer are more nuanced. Smaller, non-cash gifts for holidays or special occasions can be tax-free up to certain annual limits defined by Skat. However, if those limits are exceeded, the full value, or at least the excess, becomes taxable income. Cash gifts, vouchers functioning like cash, or recurring valuable gifts are more likely to be fully taxable. Employers should track the annual total per employee to avoid unintended tax consequences. Another important category is pension contributions and insurance. In Denmark, employer contributions to qualifying occupational pension schemes are typically not taxed as income when paid in, but they may be subject to special pension contribution taxes and will be taxed when the pension benefits are paid out, according to the rules in force at that time. This makes pension contributions a tax-efficient part of compensation for many employees. Similarly, mandatory employer contributions to statutory Social Security type schemes or specific labor market funds are usually not treated as a taxable benefit to the employee. However, employer-paid health insurance or other private insurance policies may be taxable depending on the product and purpose. For example, employer-paid health insurance that provides private healthcare access can be considered taxable income unless it falls under specific exemptions, such as certain work-related health checks or preventive programs. Remote work and home office arrangements have become more relevant, and here the distinction between business expenses and personal benefits is critical. If an employer provides necessary office equipment, such as a desk, chair, or monitor, for work-from-home purposes, This is typically not taxed as a benefit, assuming it is primarily for work use and remains employer property or is not excessive. However, if the arrangement clearly goes beyond what is reasonably required for work and effectively upgrades the employee's private living standard, taxation can come into play. Travel expenses and per diems are another area with well-defined rules. Genuine business travel, where the employee is temporarily working away from their usual place of work, can be reimbursed tax-free under standard rates set by Skat, covering meals, lodging, and incidental expenses, provided documentation and conditions are met. If an employer pays or reimburses expenses that do not meet the criteria for business travel, or if per diems exceed the official rates, the excess may be taxable as income. Commuting between home and the regular workplace is generally considered private, and employer-paid commuting costs can be taxable, although employees may be entitled to a separate tax deduction for transport, which is handled individually through their annual tax return. Equity-based compensation, such as stock options, restricted stock units, or employee share purchase plans, is subject to its own set of rules. Denmark allows certain favorable tax regimes for qualifying employee share schemes, where taxation may be deferred or treated as capital gains rather than salary income, provided that strict conditions regarding plan design, holding period, and participation are met. If these conditions are not met, the value of shares or options is typically taxed as personal income at the time of exercise or vesting. Because these rules are technical and subject to change, both employers and employees should seek specialized tax advice when dealing with equity plans. Beyond specific benefit types, two overarching principles are worth emphasizing. First, valuation. The taxable value of a benefit is generally based on its fair market value, or is determined by specific statutory formulas and standard amounts. Employers must ensure that they use the correct basis for valuation and keep appropriate documentation. Second, reporting and compliance. Employers in Denmark are required to register most taxable benefits through the e-income system, integrating them into payroll so that withholding tax and social contributions, where applicable, are handled correctly. Failure to report can result in tax reassessments, penalties, and in some cases reputational risk. For employees, understanding these rules helps avoid surprises when the annual tax assessment arrives. Many people assume that perks are free, only to discover that they increase their taxable income. It is good practice to review your payslip and annual statement to see how benefits like a company car, phone, or health insurance are reflected, and to ensure that any tax deductions, such as commuting deductions or trade union fees, are properly claimed. It is also important to keep in mind that Danish tax law evolves, and Skat regularly updates thresholds, standard rates, and interpretations. In practice, this means that a benefit that was tax-free under last year's rules might be treated differently in the future, and vice versa. Companies operating in Denmark should periodically review their benefits policies, align them with current regulation, and clearly communicate the tax implications to employees. In summary, most employee benefits in Denmark are taxable unless a specific exemption or relief applies. Key areas include company cars, telecommunications, meals and gifts, pensions and insurance, home office arrangements, travel reimbursements, and equity compensation. Employers bear the primary responsibility for correct valuation and reporting, while employees should remain informed about how benefits affect their overall tax position. Before implementing or accepting a particular benefit, it is advisable to confirm the current tax treatment with a qualified Danish tax advisor or by consulting the latest guidance from Skat. By approaching employee benefits with this level of clarity and discipline, both organizations and individuals can structure compensation packages that are competitive, compliant, and transparent.